Good afternoon, ladies and gentlemen, and welcome to the CHECKIT PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Kit Kite. Good afternoon, sir.
Hey, thanks very much, and good afternoon, everybody. I'm very pleased to be able to present trading update for the full year 23, and we'll get straight into it. The obligatory disclaimer we skipped through. Okay, so there's a little bit of ground to cover. I'll start with a set of the highlights on the financials, and then we'll explore, for those who are new to CHECKIT, the why CHECKIT, the who we are, what we do, why our industry, and why now. And then I'll cover off the pillars of our strategy and how we're looking to continue to grow to seize this opportunity. And then I'll hand over to Greg for a bit more detail on the financials before we open up for Q&A. So we're very pleased with what was a successful and consistent year of growth, organic growth in the company. ARR came in at 11.5 million, so that's 28% year on year and ahead of market expectations. Recurring revenue at 9.6 million represents 41% year on year growth. And I'll add that is the third consecutive year of plus 30% growth in recurring revenues. And it is also now greater than 90% of all of our revenues. So we're very happy with that result. Total group revenue from continuing operations at 10.3 million, representing 22% year on year growth, and cash at 15.6 million ahead of market expectations leaves us in a very healthy and balanced position as we move into FY24. And then with a view towards our path to profitability, we're very confident that our cash position will remain strong throughout that. So for those who are new to the CHECKIT story, and indeed for those who are existing shareholders, it's time to revisit what we're all about and what's so exciting about the opportunity. So who are we? What is it that we do? Really, there's three things for you to bear in mind here. CHECKIT, first and foremost, is a cloud-based platform that drives, enables, and guides workflow for deskless workers. And that workflow is used in the palm of their hands through an Apple device or an Android device or an iPad tablet. That platform is also augmented and surrounded by an Internet of Things sensor ecosystem. Okay, so the assets, be they fridges, freezers, hot holds, vaccine storage units, buildings that these deskless workers operate with, are monitored automatically by our Internet of Things sensors. The second point, the key point about what makes CHECKIT so differentiated, is that we link and we integrate the data that comes from the Internet of Things sensor devices with the data that comes from the people doing the work into the one platform. So we get an end-to-end view and an automation and digitization of the environment in which deskless workers operate in. We provide them with the technology they need to be more effective, more efficient, reduce waste, etc. The third piece that really makes CHECKIT stand out is when we think about the business leaders in the large multi-site international businesses that we tend to work with. These are predominantly COOs and CXO-1 leaders. Sophisticated dashboarding, insights, and analytics takes all of the data that is gathered from the shop floor, as it were, and turns that into real-time visibility and actionable insight. So we're in the business of driving operational improvement across the board for large multi-site operations. There is a real and fundamental need. So despite all of this, deskless workers, that's about 2.7 billion people, it's 80% of the global workforce. 73% of these workers in large blue chip multi-site, multi-geographical organizations are still using pen and paper or Excel spreadsheet to do their work, right? So even though we're in 2023 and it's a 21st century world, they're still operating like it's the 1980s. It's clearly not fit for purpose. Then you factor in rising cost of labor, supply chain challenges, supply chain disruption events, the impact of inflation, fundamental on our target audience, the impact of labor attrition, and you get a direct impact on service delivery. This leads to a situation or an environment in which our customers are operating in a dark operations environment. What does that mean? It means that the interaction, the activity between people, places, and things remains hidden from view. They can't see beneath the bonnet, which means you're inefficient, you're wasteful, you're wasting time, resource, energy, food, medical product, etc. CHECKIT platform brings this into the light and allows business leaders to make continuous improvement on their operations. The market size is compelling. So what we know is knowledge worker market, it's about 600 to 1 billion people, has about 210 billion pounds of business technology spend annually going through it. Deskless worker market, it's 3 to 4 times the size. Even if we make a few prudent assumptions that deskless workers might be less highly valued than knowledge workers, it's debatable. Even if we accept that the market itself is still fragmented and evolving, over the coming years, it's quite possible to see a market opportunity of 500 to 600 billion annual business technology spend. In order for CHECKIT to seize the opportunity, we need to be very focused. So I'll just explain the industries that we currently play in and why we do so. Okay, so predominantly we focus on healthcare, retail, restaurant, hospitality. That's about 600 billion deskless workers. Healthcare includes within it biopharma companies in the US, for example. It includes within it hospitals, both private and public. So, for example, the NHS is one of our largest customers. It also includes within it life sciences organizations and care homes, increasingly care homes, or senior living, as they say in the US, which is becoming quite an interesting space for us. Retail, for us, predominantly means food retail. But within that, of course, you've also got franchise operations from the large food retail players, and you've got facilities management, particularly soft FM, for which food to go is a core business requirement. And then the final industry for us is restaurant and hospitality. This is a core part of the CHECKIT business. The point to note here is there are adjacent industries, education, manufacturing, construction, that we expect to scale into as we harden up our go-to-market offering. So I'm going to cover off on a few of the key pillars of our strategy. There are 3 pillars. 1, we will continue to convert CHECKIT into pure subscription business. I consider this now complete. As I said, more than 90% of our revenue is now recurring. 2, we will look to continue to build scale and global growth. Scale in how we go to market, global growth in where we seek to play. So UK, Europe has been our traditional base. As you'll see, the US and North America has become a very exciting growth story for us. We'll continue to focus our efforts in these 2 regions. We have a foothold in Asia Pacific, and over time, I expect that to also play an increasing role in our growth story. And the third piece, which is really fundamental to this, is we will continue to evolve and transform the operating model of the company. One that seeks to be able to scale and grow without adding in incremental cost. But a key factor of this really is the culture of the organization that we're looking to build here. High performance must be core if we're going to seize the opportunity the way we want to. And so those growth ambitions, let me unpack them for you. There's 3 pillars to it. Again, 1, we will continue to expand and prioritize growth in the US market. Alongside that, we'll seek to double down growth in what we call the rest of the world. So that's kind of UK, Europe, and beyond. It's worth remembering we've got more than 500 customers, and the majority of those are based in and around the UK and Europe. There's a great opportunity, particularly in economic conditions such as these, to drive increased upsell and cross-sell opportunity amongst those customers. Alongside this, and of equal importance, is how we continue to accelerate our path to profitability. We've mentioned this a lot in the last 6 to 12 months. Operating efficiency in how we sell, in the way that product goes to market, becomes absolutely fundamental. And Greg will be able to articulate more on that in a few moments. If we get pillars 1 and 2 correct, then pillar 3 should start to follow 3. And we have a stated ambition to become the market leader in what we call the augmented workflow. So that's the sophisticated use of Internet of Things sensors, software, and analytics in our target sectors. I'm going to touch on a few things that have been highlights from the year FY23. So, as it relates to customers and pipelines sitting currently at just shy of 14 million annual value, that is. So it's nearer 45, 46 million of total contract value because we do 3-year minimum terms. The really important thing to note about the pipeline is that nearly 70% of that are comprised of what we would call large enterprises. That's big, multinational, blue chip organizations, billion plus in revenues. That's the fundamental basis for how we will seek to grow this company. Large enterprise customers, and we pursue what was called a land and expand model. So initial deal sizes might be relatively small, but if you're a company like Compass Group, for example, or Sodexo or someone else, customers we've all brought on board in the last year, the ramp and the opportunity to scale as the product gets sticky and as the snowball effect takes place is significant. Other logos that we typically would work with would be the likes of Stop and Shop, Greggs, Just Eat, etc. A number of whom we brought on board in the last 12 months, and over the next 12 and beyond, we seek to expand. Alongside this upside larger deal opportunities, it's fundamental to maintain a consistent run rate in the business. I think we've done a good job in the last in H2 of demonstrating that. That is consistent sales coming through the door. And that's why we also focus on what we could call enterprise and mid-sized customers. So sort of 500 million to $1 billion in revenues. They may have a limit to the total amount of lifetime value they can have. However, the consistency in the shortened sales cycles keeps the business well balanced. A word on the US. Again, really pleased with the performance of the US. Okay, so we've grown it about 91% in terms of ARR in the last 12 months. And that's a really fantastic result. It's still a maturing market opportunity for us. You know, we are still figuring out the best and most optimal go-to-market strategy. But I think the indicators are that we've got a model that works there. Okay. Predominantly, our customers have come from net new customers in the biopharma space, upsell and cross-sell within the biopharma space. Also, more recently, we started bringing on new food retail sort of franchise customers, and an interesting vertical here as well is senior living, so care homes in the US. That's had a lot of traction. So we're quite excited, and we want to continue to maintain that growth as we move into FY24. And finally, before I hand over to Greg, let's touch on a few aspects of how we're investing into the platform to make it and maintain it as a point of difference amongst the competitor base. So we will continue to onboard third-party IoT use cases. So additional Internet of Things sensor products into our ecosystem. This allows us, and this will complement the use cases and the go-to-market that we currently have with both our existing and new customers. Within the platform itself, I mentioned already that we fuse sensor data with the data gathered from people and workflows. We will move and we'll enhance the work we do from being a taskmaster and from organizing operations to guiding operations using predictive insights. This will have to be enabled through a much more flexible use of self-service, customers enabling trials, easier adoption of the platform, very easy self-service workflow development. And all of that needs to be underpinned by a robust, scalable, and resilient cloud platform, which is core to this business. Okay, so I'm now going to hand over to Greg, and he can take you through some of the numbers in more detail.
Thanks, Kit, and good afternoon, everyone. We're very pleased today to present a trading update ahead of market expectations. ARR at £11.5 million increased by 28% versus last year and was ahead of analyst forecasts of £10.8 million. So an increase of 700k versus those analyst forecasts. Cash was also ahead at £15.6 million versus consensus expectations of £15.2 million. Group revenue from continuing operations was £10.3 million, up 22% versus last year, with recurring revenue 41% up, partly offset by non-recurring revenue, which we expected to decline as we converted more US customers from maintenance contracts to subscriptions. As Kit said, recurring revenue is now 93% of the total, demonstrating our transformation into a subscription business. So let's go into some more detail on our recurring revenue performance. As you can see here, and as Kit mentioned before, this is the third consecutive year where we've grown by 30% or more. This consistent growth reflects new business wins as well as expansion with existing customers. We've been successful in renewing one of our largest enterprise contracts, and as we invest in our growth and in our platform, we remain confident in our growth strategy, and our expansion in the US, which Kit just spoke about, evidences this further. As well as growth, we've applied increased focus on our plan to drive further operating efficiencies and accelerate our path to profitability. Over the last year, we've reduced costs in our operations with some targeted headcount reduction of 10%. We've also delivered on initiatives to reduce our hardware and platform cost, which will improve our margins. Today, we're focusing on revenue and cash, so we'll take you through this more when we announce our preliminary results in late April. And now I'll hand you back to Kit.
Thanks very much, Greg. Look, we look forward to be able to unpack more of this actually as we hit the prelims in mid-end of April. But it behoves me to say that the board remains confident in our ability to continue to drive consistent and strong organic growth in FY24, despite the economic conditions that we all are familiar with. So with that, I'd like to hand over for Q&A and look forward to answering questions.
Kit, Greg, that's great. And thank you very much indeed for your presentation this afternoon. If I may, I will just bring back up your cameras. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Kit, Greg, as you can see there in the Q&A tab, we have received a number of questions throughout your presentation this afternoon. And thank you to all of those on the call for taking the time to submit their questions. Alex, perhaps now, if I may just hand over to you to chair the Q&A session with the team, and I'll pick up from you at the end. Thank you.
Thank you, Jake. So I'll kick off with the first question from Ryan. Great to see that the new contract wins in January. What is the typical sales cycle in securing new customers?
Yeah, okay, good. Let me take that one. Thanks, Ryan, for your question. There's a few factors I'd make people aware of. One, the sales cycle depends on the region, and it depends on the size of the customer. So if it's the enterprise big blue chip customer, typically you would have expected to see 12 to 15 months to land a significant foothold from which you can then expand. Over the last 12 months, because of the economic conditions that we're all familiar with, that we have seen some extension of that kind of a sales cycle. If you're looking at sort of mid-size and sort of smaller enterprise customers, those sales cycles can be 6 to 9 months, let's say. We did have a win in the US at the back end, very end of last year, which had a 60-day sales cycle, and that was actually a mid-sized customer. So there is variation within that. We're constantly striving to reduce that sales cycle, but there are certain aspects we don't have full control of. So that would be the way I'd guide people towards it.
Thank you for that. Second question here from Steve. Further investment is planned into sales and marketing and development to support growth. How much of the business moving forward does this represent?
So yeah, I'll take the first part of this, and I'll let Greg comment on what proportion of our spend is on sales and marketing. I think it is absolutely true that where we see green shoots and where we see scale, for example, in the US, we've had a really good year. We look to get behind that, and that's why we're glad to have that healthy cash position so we can invest accordingly. But it's also the case that we need to do it on an ROI-led basis. It isn't actually the case that there's a straight line between pounds spent on say new sales heads and pounds delivered within a period of time. So we have to be very balanced in the way we do that. But absolutely, where we see growth, we get behind it. A very targeted, focused way. Greg, perhaps you might want to speak a little bit more on how we balance that.
Yeah, sure. So what I would say is that we have increased investment this year into sales and marketing and into our product. We'll take you through more of that detail when we get to the preliminary results. But as a broad assumption out of our operating costs, I would say that sales and marketing and product represent about 2/3 to 3/4 of the operating costs.
Thanks, Greg.
Thank you. And then one specific question is, how many salespeople do you have in the US? And given the success there, are you planning to increase the size of that team?
Yeah, okay. So, surprisingly, we have 3 salespeople in the US. So they're quite effective. Are we planning to increase the size of that sales team? As I said just before, absolutely. The way to do this fundamentally is you build up a significant amount of pipeline and demand such that the existing team is completely saturated. And where you've seen those green shoots, you then invest behind it with new heads. I think one of the learnings over the last couple of years is not to bring new heads in ahead of demand. So ahead of getting that pipeline where it needs to be. That pipeline is now where it needs to be in the US. So I think as we move into next year, we'll be looking to bring on more heads and drive more organic growth.
Thank you. Got a next question here from David. Previously, CHECKIT has been excited about the rollout possibility with BP, with targets of 1,500 sites in 22, 2,000 in 23, and 4,924. Can you sort of talk about how that client is progressing?
Yeah, I can. I mean, it's fair to say that the enterprise renewal that we announced, towards the back end of the last year, one might assume is quite related to the BP opportunity. And what I'd say there is they're a very large customer. They're top 3 largest customer for CHECKIT in terms of ARR contribution. But like any very large blue chip organization, they can be quite slow in their decision-making process. And it could be the case, you might say, that until such contract renewals have taken place, they may not be willing to look at new markets. If we assume that contract renewal is now closed off, then new markets come back on the table. And those are just the kind of factors we're dealing with. There's the pace that CHECKIT wants, and then there's the pace that a very large enterprise like BP wants, and they don't always align. So, we have to take what we can get when we can get it.
Okay, thank you. Another question here from David. What are your cash burn expectations for the next 12, 24 months?
I think I'll let Greg take that.
Yeah, sure. So if you look at the analyst reports that came out this morning, you'll see that they're suggesting that cash at the end of this current financial year that we've just entered will be £9.5 million. That represents a good improvement in terms of the cash burn that we're seeing. So cash burn will reduce over the next year by about 30%. We'll expect the analysts to release guidance for FY25 when we issue our preliminary results in April.
Thank you, Greg. Question here from Steve. Do you see consolidation in the sector, and do you have any plans for acquisitions?
It's a good question. So consolidation I have seen actually in the US most particularly. So there was a company called GoSpotCheck and another company called Zenput, both of whom have been acquired by kind of large vertical stack data analytics providers in the last 12 to 18 months. There's some of our primary competitors in the US. Haven't seen as much in the UK, Europe yet, but that's not unsurprising. So there is consolidation. I think it's an opportunity. I think speaks to the growing awareness of the size of this space and the opportunity. In terms of plans for acquisitions, yeah, we remain absolutely open for the opportunity, and now is potentially an interesting time to make such an opportunity. I think what I'd say is that it would need to be a complement to what CHECKIT provides rather than an addition to the product set, because our product set is differentiated already. It would need to be something that brings in a new component to what we do, and that might be quite interesting. So we remain open to it. We have the cash, but for me it's about organic growth, then it's inorganic growth through partners, channels, alliances, and then you can also think about acquisition at the same time.
Thank you. Question here from Rebecca. Who are your main competitors, and are they all global?
Yeah, good question. Well, I mentioned two of them just now in the US, Zenput, GoSpotCheck. There's another one called Jolt. They are, well, it's hard to tell because they're privately held, they're VC backed. It's hard to tell how global they are. If you read their marketing literature, they're everywhere, except I don't see that much evidence of them in the UK or Europe. But we assume that they're global to an extent. There's also a company called iAuditor, who are, I think, as far as I can tell, global as well, to a greater or lesser degree. What I would say actually is that one of the other interesting differentiators with CHECKIT is that the fact of us being a listed and a mature business is also another point of difference, because if you're a large blue chip customer, let's say Compass Group, for example, where you've got a huge number of locations globally in the thousands, if not tens of thousands, and you're looking to find a partner for whom you can scale globally, maybe a conversation that we're currently having, you become more trusted. There's a certain element of trust that comes with our current status and the rigor in which we run our business. So that becomes a differentiator for us as well.
Okay, thank you. Question here from Charles is asking you, Kit, to give you a little bit of background on yourself. So when did Mr. Kite join CHECKIT, and what was his career prior to joining CHECKIT? And in order to get traction within large corporations, do you have to get buy-in within the C-suite? And if so, how do you approach this task?
Okay, it's a good detailed question. Okay, so I've been at CHECKIT 2 years now. My background is a slightly interesting background, really. I spent sort of much of the last decade working for a very large US technology company called Genpact, which effectively competes with the likes of Accenture and others. I was European sales leader in consumer goods, life sciences, etc. You're talking $50 million deals and greater. So a lot of experience driving big enterprise deals, which combine lots of different products and services in one. So that's my kind of business background. Prior to that, I also spent 7 years in the British Army. I was an officer in the Gurkhas, the Regiment Gurkhas, where I was mostly deployed in Afghanistan and Iraq. So I think that brings a slightly different leadership approach to the kind of environment that we're working with here in CHECKIT, and hopefully that will play through over time. What was the second part of that question, Alex?
The second part was, how do you get buy-in in the C-suite?
Oh, yes. Yeah, I mean, the large enterprise sale is by definition complex. It's what we would call like a consultative sale. So you don't just, a lot of SaaS companies actually just try and do a rinse and repeat model where they crank the handle, they fire out on a broad basis a very limited kind of value proposition, and then people either buy or don't buy, and then they just move on to the next. I think with CHECKIT, what we see is we put a heavy investment in demonstrating the business case, which includes the return on investment case for our customers. At the C-suite level, that requires a lot of stakeholder engagement. So that's typically where I'm playing as much as I can. I can use my experience there. And, fundamentally, you need to be able to demonstrate in this environment, C-suite decision makers only care about three things: revenue, cost, and risk. And in this environment, cost and risk become value levers in and of themselves. And that is a sweet spot for CHECKIT. So we have to be able to demonstrate a business case that clearly aligns to that and has a compelling payback period and drives significant ROI over time. And you have to be able to do that to be able to get your foot in the door. And so that's really a lot of the effort we do leads to getting to that place. And if you get to that place, you can open up a much bigger budget and potentially tie in multiple functions within the business. And that's how you can sell and scale.
Thank you. Question now back onto the cash burn. So cash burn seems to be key. Could you please talk a little more about how long your cash will last and your plans going forward when it starts running low?
Yeah, I might ask Greg to answer that as well.
Yeah, absolutely. So our cash burn, as you say, is absolutely key, and that's a great question. In terms of how long it will last, we expect that we will see for the next 3 years sufficient cash in the business, and we would imagine that by the time we start to run low on cash, we will be profitable, and we will see that cash will start to increase in the business. So those are our plans going forward in terms of where we expect break even to be, or be in the 18 to 20 million pound ARR region.
Great, thank you. Some questions here on the pipeline. What differences have you noted in pipeline in the US versus the UK and the rest of the world? And can you give any breakdown of the split of that 14 million pipeline between the US and UK, rest of the world?
Yeah, I mean, I could reveal only so much, I'd say, at this stage. What I've noticed, I mean, there's a few things. So a comment on pipeline generally. It's a completely moving feast in some sense. So when I report a number now, basically by the end of this week or start of next week, that number might be higher or lower, depending on whether we've closed one business, closed lost business, added new pipeline at the top of the funnel, right? So it's a very much a moving target. That's the first thing I'd say. Second thing I'd say is it's not always the quantum of pipeline that's most important, it's also the quality of pipeline. And that is just how well qualified the opportunities are that are in there, the types of customers they're with, are the customers profitable, are they the right kind of enterprise size? All of those factors mean that we are constantly, if you're really running a thorough sales organization, you're constantly reviewing the state of that pipeline and down to the specific opportunity, and then asking whether it's been sized appropriately. And what we've done over the last 6 months, 9 months, is we've added a bit more prudence into the measurement pipeline. In some respects, particularly in the US, actually, we typically underreport internally the size of an opportunity until we've got a lot of confidence that it's going to move towards a contract, and then that opportunity might come through in the final bit at its true value. So that can fluctuate the pipeline. US rest of the world split is roughly 1/3, 2/3, so 1/3 US, 2/3 rest of the world, and that again represents the fact that rest of the world has just a large existing customer base. It's been around for a number of years now. However, the US is indeed gaining a lot of momentum, certainly since we stood up over the last 2 years.
Okay, thank you. Comment here from Rebecca. Please bear in mind that retail shareholders rarely get access to broker reports, so please consider sharing forecasts with your shareholders going forward. Do you want to make a comment about the accessibility of the research reports from both Edison and Singers?
I mean, it's a good question. I think it is a good question around how to either educate the retail investor with the correct guidance so that they can see what we're aiming towards. I mean, Edison is available for those that can find it. Singers is a bit less available. Yeah, I mean, look, I suspect that's probably a byproduct of the nature of the system that's been set up, and I think what we'll do internally is consider how we can make that more readily available for anyone in a format that's easily digestible, and that way the message becomes clear.
Okay, thank you. And just as a reminder that the Edison and the Singers notes are available on Research Tree. So if you have access to Research Tree, you can see the notes from those two brokers there. I've just got one more question here now. It's from Charles. It says, how does CHECKIT scan the horizon in order to ensure that it is harnessing technology which delivers the best solution?
That's a great question. And that fundamentally comes down to the product vision, product strategy. And so I'd have our Chief Product Technology Officer, David Cottingham, unpack this. But the way that I think about it, the way I work on it with him and the rest of the team is that, well, first of all, tech is a very fast moving space, as we will have seen in the last 3 months with the generative AI associated with ChatGPT and the disruption that can cause to previously established industries like search and Google. So one basically makes plans that are typically 12 months focus, where we've actually got real clear line of sight about what we need to be able to do with our product to maintain a competitive position. And then it has a lot of agility and pivotability, I'd say, within it beyond that. So as I mentioned earlier, we do see a world where the use of data and analytics and insights and the ability to drive predictive assistance to enterprise operations will become more and more in focus. And if you look at what CheckIT does fundamentally, we're gathering a lot of data, and then it's how we use that data to drive value that will become key over time. I think that is a trend that will stay. How you enable that trend, be it through dashboards, be it through partnerships and others with other product providers, becomes something that we figure out nearer the time, according to in the market.
Thank you, Greg. And I've just been pointed out by one very knowledgeable attendee here that the Edison research is actually available on the CheckIT website as well. So thank you for that, Catherine, for pointing that out. And we come here to the end of the questions.
Alex, Greg, Kit, thank you very much indeed for being so generous of your time there and addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, to then add any additional responses, of course, where it's appropriate to do so. Kit, perhaps before just redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, we really appreciate the breadth and the depth of the questions. Actually, I think this time they really show an engaged audience. And as I said earlier, we really look forward to unpacking in further detail. Actually, when we issue the prelims in the back end of April, and it just remains for me to say that again, the board is confident about our ability to continue to drive strong organic growth as we enter FY24, as we call it this year now. So I really look forward to working with you all and updating you in the future.
Kit, that's great. And Greg and Alex as well, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CheckIT PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.